What if I told you that right now, this very second, the entire global financial system is teetering on the edge of a cliff, and Wall Street is throwing a party? Yes. While job creation stalls, unemployment climbs, tariffs inflate your grocery bills, and political chaos erupts between the U.S. President and the Federal Reserve, stock prices are smashing records like it's 1999 all over again. But here's the terrifying truth no one wants to admit. This isn't prosperity, it's a mirage. A dangerously inflated bubble built on blind faith in artificial intelligence, reckless speculation, and the delusion that this time is different. And history is screaming at us to wake up. Before we dive deep into why this market rally is more fragile than it looks, and why the next crash could hit harder than 2008, I need to ask you something personal. Where are you watching this from? Drop your city or country in the comments right now. Whether you're in Karachi, London, Toronto, or Lagos, your voice matters. This isn't just an American problem. It's a global warning sign. So hit that comment button, smash subscribe, and stay with me, because what happens next could reshape your finances, your job, and your future. Let's start with the facts on the ground. The U.S. economy isn't booming. It's barely breathing. Job growth has stalled. Despite strict immigration controls, unemployment is rising, not falling. Import costs are surging due to new tariffs, squeezing households already stretched thin by inflation that stubbornly hovers near 3%, well above the Federal Reserve's 2% target. Yet somehow, against all logic, the S&P 500 and Nasdaq keep scaling new peaks almost every other day. Jerome Powell, the Fed chair Donald Trump publicly wants fired, has quietly warned that stocks are fairly highly valued. That's central banker speak for, this is absolutely insane. By any historical measure, price-to-earnings ratios, market capitalization to GDP, the so-called Buffett indicator, or dividend yields, U.S. equities are among the most overvalued in history. Not just expensive, extremely dangerously overpriced. But traders don't care. Why? Because they've forgotten what real fear feels like. Think about this. It's been 17 years since the last major, prolonged bear market, the one triggered by Lehman Brothers' collapse in 2008. Most traders under 35 have never lived through a true financial panic. To them, market dips are just buying opportunities. They've only known a world where the Fed steps in, cuts rates, prints money, and props up asset prices. They assume it will always happen again. That belief, that safety net, is the bedrock of today's complacency. And that's warning sign number one. The longer the calm, the deadlier the storm. Every bubble in history, from the Dutch tulip mania to the dot-com crash, was justified with the same phrase, it's different this time. In the late 1990s, investors believed the internet would rewrite economic laws. Sound familiar? Today, it's AI. Everyone's betting that artificial intelligence will turbocharge productivity, profits, and GDP overnight. Maybe it will, but not in the next 12 months. Real economic transformation takes years, even decades, yet markets are pricing in miracles by next quarter. Meanwhile, look beyond Wall Street. In the UK, growth is flatlining. Inflation is nearly double the Bank of England's target. Businesses are paralyzed by rumors of tax hikes. Consumer confidence is crumbling. And yet, somehow, global markets march upward, disconnected from reality like a spaceship drifting from its orbit. Now, let's talk about the elephant in the room. Wealth inequality. The top 10% of U.S. earners now account for nearly half of all consumer spending, the highest share since the late 1980s. Why does that matter? Because those wealthy households hold the vast majority of stocks. In fact, 30% of total American household wealth is tied directly to equities, and it is concentrated in the hands of the richest 10%. That means the entire U.S. economy is now riding on one assumption, that the rich keep spending their paper gains from the stock market. But what happens if those paper gains vanish? Mark Zandi, chief economist at Moody's Analytics, put it bluntly. The fate of the U.S. economy lies in the hands of the well-to-do. As long as they keep spending, the economy avoids recession. But if they turn cautious, even for a moment, it collapses. And what's the fastest way to make the rich turn cautious? A sharp drop in stock prices. One bad earnings report, one geopolitical shock, one policy misstep from the Fed. That's all it could take to trigger a wealth effect in reverse, where falling asset values lead to reduced spending, which slows growth, which hurts corporate profits, which pushes stocks lower, and so on. A vicious cycle. Now enter Donald Trump and Jerome Powell, a clash that could decide America's economic fate. Trump wants Powell gone. Why? Because he believes high interest rates are hurting his re-election chances. He's demanding rate cuts, not to fight inflation, but to inflate asset prices further and create a short-term illusion of strength. And Wall Street is banking on it. Traders aren't pricing in fundamentals anymore. They're pricing in political pressure. They believe the Fed will cave, cut rates, and rescue the market once again. But here is the dilemma Powell faces. The Fed has two mandates: stable prices, i.e., low inflation, and maximum employment. Right now, inflation is at 2.9%, not catastrophic, but above target. If the Fed cuts rates prematurely to please the White House, it risks reigniting inflation, especially with tariffs adding cost pressures across the board. And if inflation flares up again, bond markets will revolt. Remember, bond yields dictate mortgage rates, car loans, and the cost of servicing America's $34 trillion national debt, now at 124% of GDP. If bond investors lose faith, long-term interest rates spike. That could trigger a fiscal crisis far worse than a stock market crash. On the other hand, if the Fed holds firm and keeps rates higher for longer to truly tame inflation, it risks choking off growth entirely. Businesses delay investments, consumers pull back, layoffs rise, recession looms. So Powell is trapped between a rock and a hard place, and whichever path he chooses, pain is coming. This isn't 2008, where reckless subprime mortgages and complex derivatives imploded the banking system. Nor is it 1929, driven by margin-fueled speculation. Today, danger is more subtle, a slow-motion dependency on asset inflation to sustain an unequal economy. Central banks, since the 1970s, have prioritized capital over labor. As economist Dario Perkins notes, they became the custodians of neoliberalism, ensuring that owners of wealth always came out on top, especially during crises. In 2008 and 2020, the Fed didn't just stabilize markets, they supercharged them. Free money flowed to Wall Street while Main Street struggled. Now that same playbook is being demanded again. But each time we use it, the side effects grow worse. Deeper inequality, weaker wage growth, and a financial system addicted to cheap credit. And that addiction is reaching its limit. Because here is the uncomfortable truth. Bubbles don't need to pop because of data. They pop because of psychology. When confidence shatters, it happens fast. One day everyone believes the music will never stop. The next day, they're scrambling for the exits. We're already seeing cracks. Retail sales are softening. Credit card delinquencies are rising. Small business optimism is fading. Even AI-related stocks, once untouchable, are showing signs of exhaustion. The market is increasingly narrow, driven by just a handful of mega-cap tech firms. That's not health. That's fragility disguised as strength. So what should you do? First, don't panic, but do prepare. Diversify. Reduce leverage. Avoid chasing hot stocks based on hype alone. Understand that volatility isn't a bug, it's a feature of markets. And remember, no bull run lasts forever. Second, pay attention to the Fed's next move. If Powell caves to political pressure and cuts rates while inflation is still sticky, it may give markets a short-term sugar rush, but it will store up far greater trouble for tomorrow. If he holds firm, brace for turbulence, but know that it's the price of long-term stability. Finally, never forget, markets reward patience, not prophecy. You don't need to predict the crash. You just need to survive it. So again, I want to hear from you. Where are you watching this from? Are you seeing signs of economic stress in your city? Have your expenses gone up while your income stayed flat? Share your story in the comments below. Your perspective helps build a global picture that no headline can capture. And if you found this breakdown eye-opening, do 3 things. 1. Like this video. It tells YouTube this matters. 2. Subscribe, because we cut through the noise every week. 3. Turn on notifications, so you never miss a warning before the storm hits. Because while Wall Street dances, the rest of us need to stay wide awake. The bubble may not burst tomorrow, but when it does, those who saw it coming won't just survive. They'll thrive. Stay sharp, stay informed, and never trust a market that's forgotten fear.